Okay, good morning on this happy, beautiful Wednesday. Before I get started, I would like to review the following disclaimer. Okay, anything that you see in this video, just remember that this is for educational and informational purposes only. The trades are based on individual circumstances, the current market conditions, and my own level of personal risk. Just remember that trading and investing in the financial markets can include substantial risk. So be sure to conduct your own research and analysis before making any investment decisions, because you're solely responsible for any trades or investments you might make and the consequences thereof. So today, what I want to talk about are the two models. These two models are models that I personally developed over the past maybe 10 years or so, just from watching the markets and just in my own personal investments. And I wanted to share these with a select few people who might come across my video, or people that always ask me, hey, how do you invest in the markets? All right. So the caveat here is that my investment style, over the years, I've decided that um, it wasn't worth my time for me to be chasing, many different stocks. Right. I believe in diversification and just, having to review and maintain a wide list of stocks. It wasn't exactly how I wanted to spend my time. And many years back, I realized as well that, if I just stuck to some index funds and just left them alone, that I did better off. I'm not saying that, my returns were, you know, uh, way above the general market returns. Some people like to post about getting 1,000% returns and so on. That was never my goal. My goal was to just um, year over year continue to increase my funds at a rate that it allowed me to grow my net worth the way I wanted to grow it. So because of that, Model 1 was created, which is really a position trading strategy. Rather than using, um, my favorite ETFs really is QQQ. I just love everything in there. Yes, there are no financial companies, but as you can see, if you go back and look at the trends over the last 10 years, you'll see that QQQ has definitely performed better than many of the ETFs. And it is a little bit more diversified. So it's not like just semiconductors or just technology. It has a little bit more diversification, right? Um, on top of that, well, I wouldn't say we all know, but for many people, when managing money or reviewing, or they talk about the market, what they're really talking about is the performance of the S&P 500. So I've always liked having a bit in there as well, because if you're going with the flow and you just have the same returns that the general market has, you'll be fine. You'll be fine as long as you keep adding more money to it, or even if you have a large sum in there already, you let it grow. You'll be fine. Okay, so in reviewing those, the S&P 500 and QQQ, um, I came across these leverage funds, three times leverage, and I know many people will never talk about them because they truly can be very dangerous, right? You purchase these, they allow you to control three times as much as the normal QQQ and S&P 500. So then someone said, "Oh, well, if I can control three times as much, maybe I should invest all my money in them." And what happens is, yes, on the way up, everything looks great. It's tripling the money on a daily basis. But we all think very positively and optimistically about what can happen when investing. But many people don't manage the downside. What that black swan event. I've been through 2000. I've been through 2008, 2009. I've been through COVID just recently, and it's not pretty on the way down. It definitely isn't. So one of the reasons why I decided to utilize the TQQQ and UPRO was more so to protect my downside than trying to gain on the upside. Okay. So by doing that, that allowed me to add more of a percentage. So you can see here, um, I'm only using like 31% TQQQ and 14% UPRO, which gives me about 45% in all. I multiply that by 3 and I'm still over 100%. So there still is a bit of an edge there, but as you can see, a big part of these strategies, both of them, hold 40% cash. All right. That could be in money market funds, brokered CDs, treasuries, or it could be just sitting there in the account, for use anytime you want. And given the current environment with the recent rises in the interest rates, um, we're getting like 5% on these money market funds and CDs and treasuries, which is really, really good. I haven't seen that since years ago when I invested, well, not even invested, put money in a savings account, back in the 2000s, I guess, or 1999 for in the ING account that was giving out 5%, so it's ridiculous where we're at right now. It's good for those people who are savers. Savers finally get the opportunity once again to make money on the amount in their account if their bank is up to date and increasing the rates as well. Um, it's bad news for those with high credit card debt because they are tied together, unfortunately. But it puts me in a good position having 40% of my cash just sitting there, um, earning 5%, while the heavy lifters are really just in line with the market. Okay. You'll see this other 15% right here. Other cash, non-leveraged. We have enough leverage, 3 times leverage in the account. For some people, including me, sometimes you there's a stock that you might want to buy, um, and this allows for that. This allows for you to utilize some of your account to just buy other stocks that you might have interest in. Whereas the real heavy lifting is done by the first 3 components. Okay. This is not something that I trade frequently. It all depends on where the market goes. I try to maintain the percentages allocation as much as possible, but it's not very frequent. All right. And this can also be done on any sizable account. So one of the things I will be showing going forward is I had set up an E-Trade account for just for me to learn what E-Trade does and what it has to offer and so on. And at first I put $1,000 in there. There are some more things that I would like to do, so I'm waiting to add another 1,000. So in the future, I'll probably, as I show, my market moves, I will be showing that account, that small account. If there's anything to do, just discussing it. Realistically, it's not going to be a lot of trading. It's more so going to be watching and seeing what's going on with the market. But the capital requirements for Model 1 are fairly low. Okay. So how Model 2 came about. So many years ago, I used to invest in real estate. I've since moved on from that, but I've had a good long career investing in real estate, maybe over 20 years. And, one of the things that I always enjoyed about real estate was having the income coming in on a monthly basis. Uh, Real estate does come with its headaches. You have to worry about renters and if they're going to renew, if they're going to destroy your property, um, insurance rates, a whole bunch of other stuff that you have to kind of worry about. And I asked myself the question, if I had to create like a real estate model within the stock market, what would it look like? And this was my attempt at doing this. I called it Model 2. Um, Realistically, it's using a covered call strategy. I'm not gonna go over what a covered call is specifically here in this video, um, but it allows you to sell call options and create income based on what you're currently holding. So, excuse me. So for the cash is still all the same, right? Um, I changed the percentages for TQQQ and UPRO just to up the TQQQ a little bit because that is where I'm really doing the covered calls. And so because I'm upping the leverage there, I wanted to reduce the leverage for UPRO. So that's why those numbers changed a little bit. And I felt like I could up it a little bit because the income was being produced from TQQQ. In addition, because I don't really require to play around with other stuff too much, I dropped the other to 10%. But for the most part, for me, that 10%, goes into cash a little bit. Maybe I have like 2% in, like I like Amazon stock, so I would have like 2% in that and Berkshire Hathaway and stuff like that, but I tend to keep the other fairly low. And then I sell weekly options where available to create income. So right now, I believe the options that I've been selling, within 60 days, they've been producing, $2.65, I believe. So you sell four of those, that's like $1,000, of income. And I keep that amount of cash, 40% of cash in there as well, because it doesn't change from what happens with Model 1. In a down market, these things can move fairly fast. Yes, you get to keep the premium, but the goal here is to not wreck my account. Is to provide some steady income, understand that things happen. In the real estate world, things happen. People can destroy your property. You can have a significant weather event. Things happen, all right, and we can't pretend that things don't happen in the stock market either. So this is more for protection. The difference for Model 2 as well is that it has a higher capital requirement. With a low account, it's very difficult to pull off the covered call. Um, I'm not getting into poor man's cover calls or any of that stuff. I just like to keep stuff basic. In real estate, if the market goes down, and I've seen this happen, I still own my house. And I'm not saying that poor man cover calls aren't good. It's just not my scope right now. I'm sure that somebody else can create a lot more income using them. But my goal really is to kind of almost set it and forget it. live my life and not have to worry about what's happening in the market. All right. But what I found is, and it's gonna change because the market has been going up with TQQQ. I think now it's at around $37, and at the beginning of the year it was easy to do this strategy because it was like knocking around 20 25. So right now I say above 50,000 is kind of like what I'm using right now to do this strategy. So that's it. And really, the goal here is not to make an incredible amount of income. It's just to make money grow at a good rate. Good rate meaning when I look at QQQ over a 10-year period, I think right now the average was maybe about 17% a year. Um, I like to get around that or beat it slightly. Um, and that's it. So these are the two models. I just wanted to make sure that I had a good explanation, um, and hopefully it's understandable.